And we're going to look here at European trends, and of course we'll pick up on some of those global trends which are common to Europe as well, and see how that looks in terms of the outlook for Europe and also the opportunities. We'll start with quick introductions. Let's start with you, Georg, and then we'll work our way down. So 30 seconds on who you are and what you do.
So hello, good afternoon. My name is Georg Gutfleisch. I'm a partner at CMS, global law firm with seat in Vienna. I specialize in real estate, mainly real estate transactions with a focus on renewable energy matters and ESG. I'm happy to be here. Thank you for joining us despite lunchtime. I'm looking forward to an interesting discussion.
Great. Sven.
Great, thanks a lot. So, my name is Sven Becker. I've been working for LaSalle for more or less 8 years now and I'm based here in Munich. For those of you who don't know LaSalle is a global investment manager investing in solely real estate, but within that we pretty much cover all strategies and asset classes, ranging from public and private real estate and also provide equity and debt strategies. Now I'm working on LaSalle E-REGI fund, which is a commingled, open-ended core equity strategy invested throughout Europe in multiple asset classes and also multiple geographies. Happy to be here.
Great. Thomas.
Oh yeah, Thomas, I'm partner at PwC in Germany, in Frankfurt. I have the pleasure to lead the global real estate network at PwC. I'm with PwC for quite a while. And I try to bring our global network to helping our clients on transforming the industry, bringing us closer to infrastructure, from real estate to real assets around the globe, which is a tricky beast, but really interesting. And also support the clients on the transformation journey, where we are not so advanced yet on digital transformation, sustainability. We talk about that for quite a while, but there's still a way to go.
Yeah, and it was interesting to see the discussion earlier just about the huge value of the infrastructure financing that was going on for AI and those elements in the US. Lars, over to you.
Yeah, my name is Lars-Henning Stephan. I'm working with AW. You may know AW. We are globally quite well known. We have about $87 billion in real estate, and half of that is currently allocated to the European platform. I'm sitting in Düsseldorf, a quite nice city, and I'm heading the value-add business for the German client base.
Great. And if anybody's there having difficulty hearing where you are, there are headphones available where you'll get crystal clear sound coming straight through. So do use those because the sound can go up sometimes during the afternoon. Let's pick up a little bit, I suppose, on what we're seeing as some of the trends, and maybe let's pick up on the differences between last year at EXPO and this year. Thomas, let's start with you first, but I'd be interested to get everybody's perspectives on what we've seen that has changed.
So the usual question at EXPO and at every fair is, how is the sentiment? Yeah, and I'm not yet pretty sure on that. I would say in general, the sentiment is, the fundamental sentiment is more positive than last year. It's a bit less positive than MIPIM earlier this year, because we saw on the geopolitical side some hiccups. But in general, the refinancing, the capital, the interest of international capital into Europe, investing into Europe, is growing slightly. Deals market are improving slowly. It's not there yet. Banks are getting a bit, I could say, politically correct. They are looking more sensitive at their situation they have on the books. I could only say they simply get more pressure from the regulator. So that's all makes me positive in the current environment for the outlook for the end of 25, but also for 26.
Okay, good. Lars, do you want to pick up next on that? What are you seeing that's changed?
Yeah, I mean, what I see is that the investors are coming back, and that investors that are visiting EXPO are, so to speak, picking up the phone again and wanting to speak to us. So, I mean, obviously they always want to speak to us, but last year was a little different in as much as it was kind of a hide and seek to some extent. And it seemed that equity real estate was some kind of shirt they bought and just put in the closet for a couple of months or quarters because they didn't like it. And now they, take it out again, put it on, go on MIPIM or go on EXPO. And it feels better now to speak frankly, more openly and more realistically about where real estate is sitting currently? What's the yield set, especially in value add, and what's the outlook?
Okay, interesting. I think it would be good to pick up with you, Sven, because obviously you've done a lot of research in that area as a house, as LaSalle, for that fund. So I guess, what are you seeing, and what has changed? What are the key things that have changed in your view?
So pretty much I agree to all of what was said before, first of that, but so to me what really made the last 12 months was actually occupier demand was pretty resilient, which to me is not so much covered on the media, so that's a pretty positive thing. And as well, markets are stabilizing, right? I think we all feel that, even though not massively, but the sentiment is just getting better.
Okay, good. And Georg, what's your take on it?
Yeah, I mean, from my perspective, I have similar feelings about the situation. So last year were quite mixed feelings. I think that from our practice, that the market momentum is picking up again. So we see that in our transactions, which were quite low over the last year or the last years. But general speed, the speed is now picking up again, not in terms of actual transactions being implemented by now, but in preparation works. So we see a lot of requests from clients to look into potential targets, to perform due diligences, to prepare potential transactions. So the general feeling is good. And we are expecting the market to pick up again and to speed also on the transaction side, hopefully beginning next year. I think that the remaining year of 2025 is still in the consolidation phase, more or less. So we had a lot of consolidations and restructurings on the market, a lot of market players having more or less difficulties also on the financing side and on the valuation side. But I have a good feeling that the consolidation is now almost over and it will pick up again.
Okay, good. Thomas, maybe, obviously there's the ULI Trends report, which I know doesn't come out yet. But obviously the research is going on into that and you're picking up the trends globally. So I suppose, what are you seeing that may be new in terms of the trends coming from the US, for example, that we may be coming to us in Europe?
So yeah, there's always every 2 or 3 years there are new, let's say, creating new asset classes that are fundamentally built on changed needs. We had the last wave, which is still ongoing. It's about all this digital transformation, where we are still struggling in Europe on creating the right scale and magnitude of providing digital infrastructure, meaning at the end of the day, data center. Yeah, it's a power issue, there's a connectivity issue, but there's so much investment needed still compared with other part of the region. That's the one thing. This trend is already here. We are talking for that for quite a while now, for some years, but we are not there at investment level. Yeah, and we also 2-3 years ago it was, yes, it's a niche. We don't do we focus on data center. Now each data center takes $1 billion, an investment of 500 million minimum. So it's really big tickets, which not everyone can do because we have this size. And the new trends, it's people want to look more about wellness and entertainment. So we have 2 big things we see globally, especially in the US. It's sports and entertainment, where in the US, but also in China, in the Middle East, a big focus on creating really stadiums and all the infrastructure around, including housing, including further infrastructure, including retail things. And the other big asset class, it's all about longevity and wellness. That's a big trend, where we also have some good players here in Europe already, but not at it. We don't have focused REITs. We don't have focused REIT, big funds that really look at these trends. But at the end of the day, not every trend that comes from the US will resonate, like the life science trend, that came over some years ago. It didn't resonate so much. We have some life science parks in Europe, yes, but not at this magnitude and scale as we've seen in other parts of the world. Yeah? And the same trends hold for Asia, also coming into Europe now, again around the same things. But I'm pretty sure that it will take some time here to resonate, because we still have enough homeworks to do in our core asset classes. The banks, as I said, are getting more flexible on solutions, because there's still a big refinancing wave. There are still sitting issues on the books, which was more shifted, yes, let's extend and pretend, that are now coming up because pressure is increasing and market is improving. So we have to solve this restructuring, refinancing cases. We have to solve the housing issue, which is also a global thing we haven't really touched. There's so much investment in, and also in office, reuse of non-core office in Europe. These are still topics. But the new trends, as I said, could be sports and entertainment, could be wellness, well-being, and these topics. Yeah.
Okay, interesting, because at the moment, there is healthcare, there is, you are looking at senior living, for example, but that focus on longevity and wellness is really interesting to see how that comes through. And I hadn't come across the sports one before, so that's always a good thing to pick up on, an expectation for me to come through. Lars, maybe from your side, from AW, you mentioned that the value add space was there. What are you seeing then in terms of the trends, what the capital is looking for, what kind of sectors they're eager to go into from your side?
Yeah, I think we have to differentiate between the German client base, which I like very much, obviously, and the non-German client base. So the Germans tend to lag behind a little in terms of they're rather, in my experience, courage driven. So all those years that have been going on since 2018, which were glorious days, looking backwards, their real estate quotas are now quite full. So we're talking about 20%, 25%-ish real estate quotas, which is quite something. And they need more time to get them down again over the next couple of years, which is quite a challenge. So that's why we see maybe, let's say, 30% of the German investors that I know, that I deal with, they are able to now step in the market and make movements, whereas 70% are quite staying behind or are bound to reducing their exposure to real estate, even though they like it very much and they understand actually now is a good time to go back, maybe also into office if it's a decent office, but also into residential and all those stuff. But they're just bound to the chair for another couple of quarters.
Okay, good. And Sven, interested to pick up your view, I suppose, on some of those US trends coming here, because obviously, there's US capital as well. So what are you seeing, I suppose, in terms of some of the capital ideas, what's moving across there, and what's driving the sector choice, I suppose, from your side, both from the research side, but also where's the traction from the capital?
Yeah, sure. I think in general, what I said before still holds true, right? Core markets have stabilized, so we see the money is already coming back, even though slowly. We see this trend now setting off, as in demand for this asset class will be there. The markets have come back to where they should be. We still need some time to grow though, but the demand will be there for the stable real estate exposure in that respect, right? On the other hand, we still do see value-add investors coming through. That's a big topic, I think, for the next year as well. In terms of sectors, we are of the opinion that the repricing we have seen has actually led to good investment opportunities across all sectors, but not necessarily in all asset types, right? So it is really about picking the right product for the market or for your client in the end. So for core investors who would be targeting 5 to 6% total returns with a high income component, some of European real estate can do that and some can't, right? So we are, as I said, of the opinion all asset classes can hold up to that within specific products. So our focus lies still on the top-notch logistics areas, also on the operated residential or living sites, and increasingly in the repriced retail warehouses, as we see that repricing has left those assets actually quite high cash-driven with a low risk component. Exactly.
Okay, good. And Georg, just in terms of the capital side, you're coming from a different perspective, but of course you're seeing which sorts of capital are looking at the market, who's preparing for deals, who's going through that process. So what sort of capital are we seeing, and what is it targeting?
I mean, this needs to be differentiated a bit. So there, sector-wise,
A little bit closer.
Yeah, sorry. Sector-wise, I see mainly three aspects. The one is digitalization, which we've already briefly touched. So we see a lot of demand, so increased demand in data centers and data infrastructure. The second sector-wise focus lies on renewable energies or energy projects. Is it PV, wind, etc.? So we are not that strong in Austria in that field, but we see an increased demand in the CE area in this section. And the third aspect is not so much wellness and well-being, but hospitality, which is a big topic. These are not really new trends, but they are up and coming, and they are picking up. And what we have seen the last years is, while the market consolidated, these areas were still somehow crisis-proof. So there was still demand, there were still transactions going on, and we hope that they are now picking up even more. Especially in Austria, there's a new initiative on the regulatory side on energy laws, which will make business cases more valuable in terms of costs, grid costs, connection costs, and energy costs. So there will be some projects coming along that have in the past not have been viable from a business case perspective, but they will hopefully be now. So it's still under review, the new legislative framework in Austria at least. And capital, from a capital side, I mean, we have seen a lot of private investors. That was the focus over the last years, but also institutional investors and funds are now picking up and sending requests for due diligence projects to look into assets that are currently still in distress maybe. So there's a lot of consolidation going on, especially in the hospitality sector, where the market shifted a bit. So there are now few assets on the market that are quite interesting, where there are public bids out of insolvency proceedings or restructuring proceedings. So we see that this is now coming to an end and close to implementation. So there was a lot of talks about it, but now it needs to be implemented at the end. So yeah, these are the main areas we see in our practice.
Yeah, go ahead. Yeah.
Perhaps one more comment to add, which would probably frames some of the things. Talking to the, I would say, largest global 10, 20 investors, what are the growth areas they identified in this, let's say, built environment topic? And it's a consistent story globally. Where do we get? Because it's always good to have an idea on the asset level, but you also need the capital. And where is the match? Where is the best match currently? It's infra. It's all about infra, and it's about debt. Yeah, real estate is still around, but from a growth perspective, I think infra and debt are the two hottest topics, which is not partly a competition, but partly also an opportunity for our industry to be creative and say, look, if we do social housing, which is part of social infrastructure, talking about data center could be infrastructure, and there are other things we already do. We have great schools. It's a big thing. We did a study in Germany, and there's so much need to invest in schools. Is that real estate? Is it social infrastructure? Really to be, how can we deliver value which also resonates with our investors? Because also what you said, the German investors are pretty shy currently. They are all working through their challenges they have on the books, to be honest, and they are always a bit later, which is not negative, but they follow the trends. So they will be, my personal view is, and I hear from every asset manager, German LPs are still tricky to get fresh capital. Yeah? That's why, again, they are also looking about what can we do in infrastructure. And now speaking as a German, we have the big announcement, we want to spend 500 billion in infrastructure. If you really talk to the public sector, they really don't know what to do with that, because the money is not spent on the top level, it's spent on the local level down there, and how to find the right mechanism, to find the right structure, to team up with public capital, with private capital, it's not clear yet. So that's a bit of the big trends which we should have in mind if we create new products and reach out to the LPs, the mantra, and we can deliver a lot of infra-related things from our core real estate industry, and we can also serve the debt fund questions. Yeah?
I think that crossover area between infrastructure and real estate, where there's obvious ones, so data centers and digital infrastructure, social housing, affordable housing, senior living, healthcare assets within that is a really interesting area, I think. Georg, you wanted to pick that up.
Maybe one addition to the infrastructure topic. What we also see is the energy grids in Europe, in Austria, in CEE, in all of Europe, they are under distress. So a main trend may also be identified in the area of battery storage and grid investments. Which is quite difficult, especially in Austria, because it's all state-owned, so it's difficult for private investors to get into this area. But battery storage projects and renewable energy projects, they are one aspect where there is still access, at least in Austria, also from a public side. It's a bit difficult to get public governmental approval, and the process is very long, so there is also new legislative innovation coming with the Renewable Energies Directive 3, which will boost the expansion of renewable energy production, which provides opportunities for investors, also real estate investors, to invest into infrastructure and hopefully also make a business case out of it. This is has always been a struggle, at least in Austria, to earn money with these investments, because they are expensive, also in not only for the establishment and construction, but also for the maintenance of these assets. This is maybe a big trend which can be identified going forward, and yeah.
And that's perhaps taking this battery example, which is absolutely right. I was at a venture capital dinner last night with PT1, and they also invested in 2 battery storage, plus also some energy grid things, but especially into battery storage startups. And these startups are now at a growth phase, and now they teamed up with classical infra and real estate investors, because you need land to put this battery storage parks in. So again, there's like real estate is getting blurry into infrastructure, but also into this VC space, because now the big financing rounds are not with the classical VCs for this battery storage creators. They are now with classical institutional money. Yeah, so it's also combining here at the more riskier end, I would say, as venture capital is, which is now coming into this transformation piece into real estate and infrastructure.
Yeah, and you're also getting some interesting crossovers, I think. If you look at the logistics space, 2 of the sessions we were doing yesterday were picking up on the fact that battery storage is becoming a much more significant part of the client base across Europe, and is expected to increase because the first series of EV batteries are going to need recycling soon as well. So therefore they will need space, and the new batteries will need space, and that's an increasing area and a trend that we should see more increasingly. Lars, in terms of just in terms of the sectors, I'd be interested to get the view from anybody on this, and value add may not fit this, but last year I was saying to people in the trends topic, is it retail? Is it coming back this year? And everybody was a little bit quiet about it. But now I've had people saying it's definitely coming back, and we're doing very well in the retail space. So just people that I've bumped into who are retail investors saying, actually, it's been a great 3 years for us because we've been buying in that space. So I don't know whether anybody has a view on the retail sector specifically.
Definitely, it came back. So retail was bashed for, I don't know, close to a decade. And I think the last 2-3 years it came back. And you mentioned also the family office money that's chasing high street retail. It's back really at good prices. it also comes with retail is driven, especially the higher end, by tourism, which is booming really. So that's working well. But I'm not the deep retail expert. I think it comes which piece of retail you really mean. I understand high street retail is doing well again. Some shopping centers are doing well. I was in Portugal, in Lisbon, some weeks ago, and there the shopping center market is really, they said, it's so active again. Investors are coming back, and you can still, prices increased already for the last 2 or 3 years. So retail in general is back. Not every part of retail, but some parts are really back and had the opportunity of good returns because the basis was so low after bashing with online trade and blah blah blah. So there are still some good opportunities around in retail.
Okay, good. Yeah.
I'd also say that retail is back because it just has bottomed out from two sides, right? So rents have been falling for quite some time now, but now they're back on the upward cycle again, right? Plus, in the meantime, yields have also fallen and have bottomed out. So you have a asset class, as you say, it's been like bashed for decades. That's now, on the brink, let's say, to getting traction again. But I still feel that people are reluctant in that respect.
Okay, so good news on the retail front, but it may take a little more time. So let's see. That's good. One of the trends that came up in a number of the conversations that I've been having is, sadly or otherwise, but nonetheless, the defence spending in Europe, the increased defending in spend, how that's going to be impacting on different cities, different areas, from logistics, but also all the way through to office and other areas. So I don't know if anyone has a view on how that may play out. Is it something that's less of a real estate topic? It may have a smaller influence. What's the view? I mean, certainly in logistics, there was an expectation that it would. Lars,
yeah, I think if we, this is a very good point, because if we look at, for instance, the CEE region, especially Poland is a great market. We love Poland, especially for logistics. But of course, we now realize that investors, especially German investors, are very shying away from it. I mean, if you look, none of the core investors really has bought anything in a couple of months because of the drone topic and other stuff that's coming up, which is very sad. But I think it's no longer, you have to have a conviction as a house, as a firm, as to whether you want to go to the CE, for instance, now, or whether you just step away and look north, which, doesn't have to be better necessarily because it's almost the same distance,
Is there a drive then? I mean, we've seen super success in terms of looking at the market of, Spain, Italy, Portugal, Southern Europe more generally. Is that at the expense of Central and Eastern Europe because of that, do you think? Or are there separate drivers at work?
I don't think that the investors I'm dealing with, they don't really choose between, let's say, Poland and Spain. Because to them, which is right in my view, these are different markets totally, aside from the Russian aggression or whatever you want to call it. So my answer is no. So most investors that want to go to Spain, they do it because of the GDP or economics, and it's not for other reasons. So,
okay, good. And Sven, I don't know if you want to pick up on the defence side and whether that's got an influence in terms of how you're looking at the market going forward.
Yeah, so we as a house have a broader view on the defense spending side. Most of you might have heard about our ECGI index, the European Cities Growth Index, where we have been tracking parameter that drive tenant demand for actually 25 years now. And this index has always been adapted for global trends that influence tenant demand, which is why, for example, 3 years ago we added climate data points in that. But this year specifically we added as to how much each city or region can be expected to benefit from defense spending, right? And it turns out that there's regions throughout Europe that will benefit more, most likely, because it's just they're closer to the production schemes where ammunition, tanks, or whatever are manufactured, which would be southern Germany, central and southwest France, but also the Stockholm region, for example. Now, coming back to the logistics part, logistics has had quite a dizzy year as well, right? I mean, with vacancy picking up, but this might be a counter indicator coming back, because with ammunitions being built, tanks being built, somebody needs to store it, right? So that might be that demand side that has been lagging now for last year.
Okay, good. Thomas, you wanted to come in briefly.
Yeah, just a comment. The defense is a wide range of. It's not just the Rheinmetalls and Leonardo creating tanks and munition. It's also the question, and that's again speaking as a German, listening to the public sectors, and every sector in the economy, including the real estate, has to rethink how can we deliver a positive impact in case of war. How can we put our infrastructure in a situation that can support, can help the soldiers, can help tanks just to be transported, to deliver food securely to the army. So it's all the supply chains, and if you think about that, it's more or less all parts of the business are relevant for a robust defense situation. And that's where the German government, and I guess most of the European governments, are supportive in creative solutions, what we can deliver. And that's also an opportunity. It's really a bit agnostic now, but of course we can speak about how we can create more stable bridges and more stable streets. Again, that's infrastructure, it's not real estate. But also in real estate, especially logistics, how can we include this into the defense supply chain? And the government is willing to pay a part of that. So that could be also part of the upside, not being a core delivery party for defense like tanks or so, but giving the infrastructure, creating the built environment that supports a potential case where we hope will never happen, that we have to really move into a war. And that's something we hear. A second comment from some of the US investors looking really broadly globally, and we heard from some of them, why should we do Europe now? You are at war. And that was really where I thought, ooh, wow, that we are hopefully far away from that. But that's something, it was not a significant part of the comments, but I heard one or two comments avoiding Europe because there is a potential war in space, or at least the risk return must be adjusted. But that's the main comment. I said it's more positive towards Europe. Again, shifting capital around the US more into Europe.
Well, and that's interesting because speaking to people sort of over the past 6 months, it's been much more about people not investing in the US and actually shifting their capital to either Asia or to Europe because of those. So that's a very interesting topic, I think. I wanted to, you mentioned there as well the climate side and how that may impact in terms of the research that you were doing. ESG, sustainability, decarbonisation, obviously a big trend as well. Slightly quieter this year in terms of discussions. We've got a session coming up later on at 4 o'clock looking at decarbonisation and actually how you put that into place rather than the good or the bad of it, but actually how you do it. But what's your sense? Because there's also climate resilience, for example, which you have to look at, increased rainfall, extremes of temperature affecting the built environment. So how do you see those in your sense? And I suppose let's pick up what that means as well for green financing, maybe Georg, green leases, how we're seeing that. Is that building into valuations a little bit? So who wants to pick that up?
I think it's being implemented, but it's being, let's say, it's being accepted in the meanwhile. So we had the heydays of ESG, unfortunately, fortunately to some people, have ended over the last couple of quarters, in my opinion, or my perception. But it has been incorporated and it has been accepted that we need a certain level of ESG, be it in due diligence or be it whatever you say in the lease agreements, in the financing, etc. So it's rather, I don't want to say it's muted, but it has been accepted on a certain level. And now we deal with it and cope with it, and it's okay. But we don't overplay it. We don't overpace at the moment. This is my perception.
Yeah, maybe from my side, I have similar observations. So ESG has been discussed at length and very detailed over the last years. Now it's getting very silent about the topic. Obviously because of the regulations. So from the regulation side, we had the omnibus. It's been delayed. So the implementation of certain ESG legal frameworks have been delayed for 2 years or 3 years. So there was a lot of discussion because it was immediate at our doorstep, which is now no longer the case. But I also have the feeling that the topic has been accepted in the industry. It's being implemented, and there is not that much fuss about it as it was before. We see in terms of green lease, for example, a lot of our clients, they have implemented addendums to their lease agreements or incorporated green lease clauses into new lease agreements. Also from the construction side, there's more emphasis going into ESG aspects in terms of renewable energy, energy efficiency, etc. But it's not that much present as it was before. So it's silently implemented, but there will be a fuss in like 1-2 years again when it's again immediate before implementation to see where we are at and whether the real estate sector did a good job on implementing the ESG aspects in the meanwhile. But it will come back again. So it's quiet now, but the importance of the topic will rise again in 2 years.
So if I may add to that, to me, as to why it's not being discussed so heavily is because we're not discussing the why anymore, but it's more about the how do we actually do it, right? So, and that's maybe a point where the industry still needs to find itself. I mean, we at LaSalle, we are investing in smart solutions to get energy intensity down, right? So to me it is about that's why it's silent in the end, right?
Yeah. And do you think it's moving to a point where it's a value driver? I mean, how do you see it within the component when you're looking at the research side? Is that positive for a city that is more sustainable, or is more, do you see that as a positive in terms of value creation, I suppose, when you're looking at cities, for example?
Yeah, sure. For us at LaSalle, sustainability is a driver for investment performance, right? And if I look at the capital markets in the transactions, we realized that actually there are deductions for ESG capex being accepted by the sellers and of course the buyers asking for that. So this is kind of heading towards the brown discount topic that lots of people have been talking about, right? Now, whether there's already a green premium, I wouldn't fully agree. But I mean, the ones who are doing good jobs for sustainability, are in the focus also in the ESG regions, right?
Do we think that transition is therefore a big opportunity in a sense, because it's for sure a value add play, but it's also moving positively towards those elements? Is that an opportunity?
Definitely, and it's a longer journey. Yeah, we started the journey, and always, if you want to do something new, sometimes we overshoot with regulation. It was heavily driven by the European regulation, which was good at a starting point. Now with Omnibus, we said, look, let's balance that out. Let's find a pragmatic solution, but not leaving the goals behind. On the energy efficiency, I think the topic 90% of the discussion was always about energy efficiency, and that, as you said, I would say in new constructed building, it's implemented. It's there. Nobody would create an inefficient, non-green building, however you define green. The stock is still a challenge, because the regulators are shy, especially in housing. They don't want to force housing owners to invest and avoid another struggle with a housing problem. But now the next wave starts. Now we talked about energy efficiency. Yes, we learned a lot. We are doing a lot. Yes, there are a lot of startups. There's still a journey. But now the next topic, like biodiversity, is coming up. How can the built environment have a positive impact on biodiversity, which also helps the cities to have better air and a better feedback from the people, because cities have to be attractive to attract people, to grow, and people really have the choice to say, look, cities like Barcelona and other cities, Singapore, are really growing, and one argument is not just the commercials, it's also how livable is the city. And 50% of livable is sustainable, green, good air, and that all comes with with nature, bringing the nature back into the cities. Yeah.
Good. The session that we'll have, if you're interested in this topic, then we will have a session of later on this afternoon. There's living, there's student housing, there's logistics, and then there is also one particularly focused on decarbonisation. And there we've got the City of London, the City of Turkey. So a real connection between the cities as well as the investment side in order to how to deliver that. But interesting that you see that as something of an opportunity. Georg, I'm stopping you talking. I'm sorry.
Maybe one addition. So the ESG topic is not only a question of whether you want to do good or want to support also social aspects, but it's also a question of financing. What we see in practice is there's almost no facility agreement for a project that has no green lease clause or clean lease, or green requirements or ESG requirements in it, which are also penalized if not met. So it's also a question of financing to implement ESG. So it's not a question of nice to have, but it's actually a must have to get the project running. Yeah.
And on top, it's the insurance groups that are looking at that. The tricky part is banks and insurances have different KPIs, sometimes in conflict. Yeah. But example, in the US, if you don't comply with some minimum ESG regulation, you don't get the insurance. And if you don't have an insurance, you don't get a loan. So that's and it all comes from and that's the good move. It all comes from an return perspective. Yeah, do I want to have better conditions in financing or more liquid, better conditions in lower insurance premiums? So was one quote in our last emerging trend report. It comes from away from pure regulation into what's the return on investment, and that's the right question, because then it makes also sense for all the investors that are complaining, I just have to spend more money and provide more data to the regulator. It's just a cost pain, more towards an argument saying yes, it's an improvement in the return. So there is a return on investment.
Okay, good. Just to check, does anybody have a question here? Because if you do, now is a good time whilst the session is on. It's good. Yes, go ahead. Let me.
Thanks. Given the unprecedented level of disruption we've seen in the last few years, the COVID lockdowns, the war in Ukraine, Trump tariffs, has this put any pressure on the lease structure at all in terms of has it had to amend, has it had to change? Do you see adaptation happening there?
Okay, great. Who wants to take that?
You mean technically on the setup of lease agreement?
More flexibility, yeah.
Yeah, I mean, there have been a lot of discussions when Corona, the first lockdown came. There was regulation in place in Austria. Giving the right to suspend lease payments and for the time the property is not usable due to a force majeure event. There was regulation, which was, however, in the application very, very limited and very difficult to enforce, actually. But what we have seen in subsequent lease negotiations and also in transactional, not only on the lease side but also on the transactional side, is the rise of force majeure clauses and contractual precautions in this regard. So if something similar happens again, so it was a couple of months or even years where this was omnipresent in our practice. So we filled our template books on clauses that can be used in this regard. But I have the impression that now the focus is slowly shifting away from that. But there's still contractual need on that side. So from a regulatory perspective, it's difficult. So nothing really has changed in this respect. But the focus on the contract side, it's definitely here. So we see a lot of force majeure clauses and precautions for lease payments if the property is not usable due to a pandemic, for example. So most of the time COVID-19 is especially mentioned. It's like if something similar happens in the future, then we want to have certain rights. So it's always a balancing on when these rights or obligations kick in. But it's there, and nobody was really aware of that before COVID-19 really hit. So everyone was confronted with contracts which did not include these clauses. Now they do, most of the time, hopefully. But yeah, there has been a shift on the contract side and on the negotiation focus in this respect. But yeah, maybe.
Yeah, if anyone wants to pick that up too.
I would say, like, from my portfolio side, I can speak to that as well. So what I've seen is increased requests for more flexible lease structures, but at the same time, tenants are asking for higher quality spaces, which kind of is like a mismatch between landlord and tenant request, right? So actually, in all cases, we were able to negotiate the leases to lengths and like flexibilities that we as the landlord required. But which is also comes down to, I mean, we had the product that the tenant really wanted. There was competition, so there was no point in giving away your lease length for flexible lease.
I think market-wise, one can say that markets that have ever been a little more flexible than the German markets, for instance, like the Polish or the Spanish, by tendency got even more flexible. In terms of that, for instance, it's way more difficult to get a 7-year fixed term in Spain than to get it in Germany, and this has been pushed again by those happenings.
I would say the good old times, so the 20-year lease contracts are over. So it's the trend towards more the 5-year agreement, some green terms in it. The shift towards management contract, like we see in hotels, that's not there. We had the request, like with the office management companies, WeWork, etc. That didn't happen because behind that, it could be in the interest of the owner, but then the banks come up and say, oh, you have only short-term lease agreements, we can't finance. So that's still a move, but I think the understanding of that the real estate is something operational, which is not I created and I put it away for 20 years, that's gone for quite a while now. So I think that's the big change, and we can learn from other countries in other parts. Germany is still conservative on that, but it also comes with the financing banks, with insurance group that always want to have this long-term stable view, no problem. But if leases go up, it comes with a challenge. The leases are fixed for 20 years on a low level, and you can't increase. So it's always, but could also be in the other direction, yeah.
It'll have to be very quick because I'm fearful that it's beginning to be billable now.
No, just one addition regarding the fixed lease and the long term. There are actually two aspects in Austrian regulations in this respect. The one is that in the residential area there needs to be a minimum fixed term, currently at 3 years, so they're now discussing to expand it to 5 years. And the other topic is, which has been in the news lately in Austria, are index adjustment clauses, which are a very difficult topic in Austria, also in terms of case law, whether they are enforceable or not enforceable, especially towards consumers. So in the residential area, not so much in commercial leases. But these are two topics that are intensively discussed at the moment. So we are there is now certain level of legal certainty on the index adjustment front, how these need to be structured and drafted to be actually enforceable, but also in terms of lease terms, we usually see like 5 to 10 years, but not much longer. There are some exceptions if you have a significant amount of investments that the lease terms are longer, but the normally would be somewhere between 5 and 10 years with extension rights or options to extend the lease under certain requirements. But yeah, this is a topic.
Great. So mental note to self, must include separate session on lease structuring. That's what I'll need to do. Very quickly, because we're desperately out of time, and I can see Courtney waiting to almost start the next session. But from the two investors, trends, but what does that mean for opportunities? Where would you be investing based on the trends? Where do you see the biggest opportunity?
To me, it's still beds and sheds. I know it's been said 1,000 times before, but we are very much looking at residential, and we are seeing that, especially in the southern countries, aside from Poland, which is also very attractive, we see that the younger generations are tending to not own, which is giving us so much opportunity, especially in Italy or Spain, because you have a great combination, from our point of view, between old stock, dated stock, and people wanting to rent, and there's no opportunity to rent, so it's quite nice.
Great. Sven?
I'd add to that the retail part, actually, because I think you can find the highest cash-producing opportunities in this sector nowadays. So for me, it's beds, sheds with high quality, as I said, certain types, not all of it, and the highly repriced retail warehouses.
Great. Well, if you are interested in beds, the next session is on living in Europe, covers all of the asset classes within that. And then immediately after that, there's a drill down into the student housing, co-living, micro-living section. So if those are interested, do stay for those. And then we also move from beds into sheds. There is then logistics is the one following that. Thanks very much to everybody for joining us. Thank you to the speakers. Thank you very much.